my name is Austin and I am here with 10% Credit Spreads. My whole goal is to teach you how to make 10% a month for free. I give you all the strategies step by step and hope that one day you join me in my Inner Circle program. All right, let's jump right into it here. This is how a put credit spread works. It makes money based on 3 different scenarios. Number 1, the market goes up, you make money. Number 2, the market stays the exact same. And number 3, if the market goes down just a tiny bit. So that's a lot more of a chance of winning. You have a higher chance of winning than buying a stock where if it goes up, you make money. If it goes down, you lose. Instead, if it makes up, you make money. If it goes sideways, you make money. If it goes down a bit, you make money. That's the beauty of put credit spreads. Let me explain how this works and why it works. The first thing I want to show you is how to set up a put credit spread, because that will help you understand how this works. So first off, we go to a stock. If you're seeing here, I'm trading credit spreads on a small account to show that it's possible. I also trade put credit spreads on a 6-figure account. So again, you can do it on anything you want. But again, we're going to go here. We have to have options enabled on the broker platform we're using because this is an option strategy. You can go to Builder if you want. But again, I want to show you how to do it step by step. But if you go to Builder here, you select an up move and you have put credit spread right here. But we're going to do this ourselves. So let's reset this here. Get out of Builder and let's set this up. So let's say we're going about, let's say 7 days out on our expiration. And what we're going to do here is we're going to switch over to the put side because they put credit spread. And now again, typically, if you ever heard of puts, puts make money or puts go up in value as the market drops. And that is still true. However, when you sell something to open, it does the opposite. So now, since we're selling a put credit spread, we sell to open this, which I'll explain here in a second. That means that when the market goes down, we lose money. When the market goes up, we make money. So it's the reverse when we're selling first. All right, here we go. Let's set up a put credit spread. You typically go out of the money, which means that this is where the stock is currently trading. Anything above this on a put is in the money. Anything below it is out of the money. So let's go around here. So what we do to set up a put credit spread trade is we sell a first strike. And this, how do we pick the strike? Well, the strike is picked based on where we think SPY will stay above by this expiration date. Let's say I think SPY, currently trading at 393, will stay above 383 by March 27th, so in 7 days. So if that's it, then what I'm going to do is I'm going to sell the 383 strike price. So right here, let me add this. Sell. Here we go. Sell 383. Okay, there we go. Sell 383. And then what we're going to do is we're going to come, because if we just sell a 383 put, we have this max profit, but we have unlimited loss. And so we don't want unlimited loss. Instead, we want to actually cap our losses in case the trade goes against us. So what we do with that is we buy another put below that. I like to say a $1 strike, which means I just pick the next strike below it. But you can technically pick a few strikes out. It's going to increase your max profit. It's also going to increase your max loss as well. But I like to stay, and I recommend staying within one width. So you can see here, if I sold the 383, or I'm selling that one, then I'm going to buy the 382. So I'm going to buy this one, come in here, and I can collect a credit of 17 cents. Now let me just tell you the rules for it working out here is that if you're collecting 17 cents, since each option is equivalent to controlling 100 shares, you're actually being paid $17. They're paying you $17 to put this trade on. So you're giving somebody else insurance, and they're paying you the $17 to put this trade on. And what happens is, if the stock, if SPY stays above your first strike, above 383 by March 27th, which means on March 27th, at the end of the closing day for that trading day, if it's above 383, you will get to keep the whole $17 and nothing else happens. You get $17 for free. If not, if it goes below 383, then you're going to hear what is called assignment risk, which is where these options are going to be assigned to the person who bought them from you or sold them to you. Who bought from you, sorry. Anyways, so how that works is you're putting up the difference here. So 383 to 382, that's a $1 difference. Now remember, options represent 100 shares each. So this $1 difference gives us a max loss of $100. However, what's amazing is that we collect $17. So although we have a risk of $100, we get to add the 17 back, giving us an $83 max loss. So that's how you calculate your max loss and your max profit. So we can come in here, you can see it's saying 17 credit here, but it's expecting us to collect $20. So if we collect 20, then we have an $80 risk, and our break even is $382.80. So that is how you set up a put credit spread. Now, what exactly does this mean for you? Well, I wrote a blog article on this to explain in depth. So if you like reading more, go check this out. But with the chart right here, this this is what it looks like. When we sell the first put contract and then we buy the next put contract, which defines our risk, we make money as the stock goes up. So this is the stock price. As the stock goes up, we continue to make money, the same profit. If it stays neutral, which means that, because what typically happens is the stock price is right here and we're selling the first strike way out of the money. So we have this. So if the stock goes up, we make money. If it stays neutral and trades around this area, we make money. If it goes down a bit, we even make money. And I typically, on my credit spreads, go out about 2 to 3% below that current market price. So that means the stock can drop up to 3% and I'm still making money. Again, when you trade with the trend, it's way easier. Anyways, that's how you make money with put credit spreads. If it goes against you, you're going to hit that max loss. Now, typically, if it's trading around at the money when it's near expiration time, you can typically buy back for less than your max loss. Therefore, you're not going to realize that full max loss. Anyways, the bare minimum is put credit spreads to make money on the way up, neutral, and even slightly down. You set them up by selling the first put and buying a put below it for protection, and that is how it works. All right, guys, I hope this made sense. If so, please smash the subscribe button, and I'll see you in the next video.